Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 20 to 25 minutes here on Options Guide TV. So in the markets, choppy markets, trying to set new highs, talking about a rotation going into small cap stocks. The Fed, it's actually came up from one of the governors of the Fed to actually think about a rate cut here in July. I don't think it's going to happen. The futures marketplace is not pricing it in, but they are setting the marketplace to see a rate cut in September. Right now, the futures marketplace is saying there's a 100% chance that they are going to be cutting rates. So mixed earnings we had with Google and also with Tesla. Tesla is down quite a bit today, which is dragging down the NASDAQ 100 index with it. Indexes are just showing weakness across the board. The Russell 2000 is actually down the least amount today, and there's a lot of pundits that are mentioning the rotation of the Russell 2000 index. And recently we did a long straddle in that index, and I still like that trade. We've came back down into the middle of the channel. I still think you could do a rinse and repeat on that trade. I'm not going to cover that today. I'm going to look at actually doing an out of the money call spread, only because I'm seeing the pump up in implied volatility. And I think it makes it a little bit more interesting because I do not see the Russell 2000 index in the short term breaking through to a new 50, I guess would be a 52-week high or yearly high in the IWM, I guess would be a better way to say it. So got to address what happened in Google. Google is down on the day. And on Monday's show, we did a low risk out of the money butterfly, but we actually skewed that butterfly and we gave ourselves more upside potential than downside. And if we look at that trade, what we see is that we limited our risk down to $1 for every 1x2x1 butterfly, for every ratio that we did, but we did need a move up in the marketplace. And overall, Alphabet, i.e. Google, had solid numbers, solid growth. I guess the biggest concern would have been in the YouTube ad space. Now that they've broken that out, they are highlighting that they had a little bit of a downturn in ad revenue on YouTube. But overall, the numbers were really good. The stock is getting beaten up, and I do think it is a buy the rumor, sell the news scenario. Google has been very strong. Actually for the entire year. And I think some people are taking some opportunity to take some of that money off the table. But bottom line is that it did not work out well for our butterfly trade. So I do need to look at that trade and just kind of show you where we're at. So let's run to the Tradier Pro software and pull that up. And right now I went directly to the what if calculator. And what I'm showing, there's really not much left in this trade. So I don't want to confuse things. So let's get rid of that. There we go. And we'll bump this up just a little bit. Okay, so here's what the trade was. We had Google is down right now on the day, down $6 or about 3.5%. Not much different than the expected move on Google, by the way, just to highlight that. And I'm going to call it Google going forward. It's easier to say than Alphabet, so we're going to leave it there. And this is what we did. We bought the 190 strike. Here's our strike right here. We sold 2 of the 197.50 strike, which is here. And we bought 1 of the 202.50 strikes. Now, when we put the trade on, the market was obviously 6 points high. Well, we did say that we would adjust the trade. We did it on a Monday, and recommendation is usual. We only tape Options Guide TV Monday, Wednesday, and Friday. So I would have looked at the trade prior to the earnings because this was 100% an earnings play trade that we were doing, very speculative overall. And the market was at 180-ish in there. We bought the strike within the expected move. In other words, the marketplace was expecting the stock to move at least above and beyond, if the news was good, above and beyond the 190 strike. And then we have, if you look at the P&L here, we'd have unlimited upside potential or we'd have a gain no matter if it went anywhere from the 190 range all the way on up. 191 was our break even. Any point from that point higher, we were solid on the trade. So we adjusted this butterfly. We bought a tighter wing, gave us a wider long spread than the short spread on the trade. It cost us a little bit more, but if Google blew the numbers out of the water, we were still okay on the trade. We still would have had a decent profit. They did not. Market is down here. This thing is trading for zero. To have a chip in a chair, though, here was one of the benefits. And this is part of the reason why we structured the butterfly the way that we did, is that Alphabet/Google was announcing earnings on Tuesday after the close. So now you have all day Wednesday, all day Thursday, all day Friday before these option contracts expire. I wouldn't do anything on it. There's no reason to close it out. We had on our one butterfly, our one unit, our maximum risk was $1 or $100 plus any fees to get into the trade. And now we're down on that trade. So we limited our risk by doing the butterfly to start with. On the trade, it hasn't panned out, but we still have a chip in a chair. And it is possible, considering, once again, as I mentioned, I think this is more so an opportunity for people to take some money off the table after their earnings reports. But there was nothing in that earnings report that was really scary as far as Alphabet was concerned. Tesla is a different story, but we're not trading Tesla. So we're going to move on. We're going to go to, and I should mention, if you are in the Tradier Hub or you are on the Tradier YouTube platform, you can ask questions. So just put the question in that chat box, and I'll be happy to address any questions that you may have on the Google trade. And now I'm going to actually move on. There's nothing in earnings. We like to speculate on earnings when it's earnings season, just to try to give you actually a different perspective on option pricing, on how you may speculate on these different underlyings based off of their total value, based off of where their implied volatility is at. And there's nothing that's of interest really to me today. We had AT&T on the open, and going into the end of the week, we have some interesting underlying stocks. And on Friday, we'll probably look at a few trades for the coming up week, because we're going to start getting into a lot of the mega tech stocks here very shortly as far as earnings are concerned. But today I'm going to do a simple trade. I like where the Russell 2000 index is. I'm always curious about what's going on with the small caps. And I'm going to just do a simple short spread, which I haven't done one in a while in the Russell 2000 index. So first of all, let's start by looking at the chart. And what we have done in the Russell 2000 recently, the trades have actually worked out pretty well. We going all the way back to a long channel. This is the one underlying, or the one index, and we're looking obviously at the ETF that tracks the index, the IWM, that I don't mind doing a long straddle in every once in a while. And the ones that, when we picked our moments, we've done fairly well on Options Guide TV in IWM. Obviously, if we're putting on a trade, we're doing it at that moment during the show. But we also came in and did a trade right here after we had the big run up. And then that obviously paid, because we came all the way back down to the lower end of the curve. So we had, I think we paid $9 for it, went out about a couple of weeks in time, and it paid like a couple of days later, because we went from 224 on, this is closer to the close on the high end of that candle, all the way back down to 215. So the put would have paid for sure, hung around in that range, started to come back, and now you could actually sell out the call option. So we're going to move away from that trade. Now, we've established a new channel, even though we don't have a lot of days that to go off of 1, 2, 3, 4, 5. We have 6 trading sessions. But right now, considering where the market is at, where the volatility is at, I want to sell a little bit of premium. So I'm going to go above where the new recent high was, right around the 225 level. And we're just going to sell a short call spread. It's going to be a couple of weeks out in time, and we're going to manage that trade. And we're going to try to sell some of that volatility premium, thinking that it's going to be rough in the short term for IWM to try to get back to these levels after this strong move up in IWM. I do like the Russell 2000 index as I think you should have some of it in your portfolio. I think it's time to do a little bit of rebalancing in a portfolio, sell a little bit of the mega cap tech stocks, buy a little bit of the small caps going into a potential rate cut in September. Don't mind that strategy at all. But here on Options Guide TV, we're going to look at a little bit more speculative trade and just look at selling a short call spread in IWM. So let's set that trade up. And let me check, see it. We do have one question here. All right, so quickly, Karen asks, and we can put that up, should we let this trade expire? Well, yes, in Google, you should let this trade ride out. Like I mentioned in the Google trade, and I'm sure that's what Karen was referencing. We managed our risk when we put the trade on. It was we paid $1 for the trade. We were within the expected move, let alone the 1 standard deviation move. But for some reason, the marketplace decided to sell off based off of a decent earnings report from Alphabet. Maybe it might be a little bit more about the shakiness in the marketplace than anything. And you still got a life. You still got 3 full trading sessions before this expires. So is it very possible that we could move back to 3% today and move back up another 3% before Friday? It's not probable, but it is possible. So I would ride the trade right now. There's no adjustments that we can make on that because the option contracts really don't have much value in it. You need premium in order to adjust the trade, but they're trading for next to nothing. Let the trade right out. I would not close any of the shorts. I wouldn't do anything else. I would just watch it closely, set an alert for our long strike on our, and let me grab that right here, the 190 strike. Set an alert for this range on Google, and if it gets in that range, go back and look at the trade again. That simple, straightforward. All right, no other questions on the Google trade? All right, let's move into IWM. So here we have 221.86 is where the market is at. This is the Tradier Pro software highlights the most at the money option contract. We're going to go out approximately 1 standard deviation move. We're looking at 233 here. The delta on this option contract is 20, so it's a little bit less than a 1 standard deviation move, but that's where we're getting some what am I trying to say? Some premium. We're getting some premium for that option contract. Going 16 days. This is the Friday expiration. I like to trade the Fridays if I can, as opposed to if you look at the August 7th, that would be considered a daily expiration. I like the standard Friday. Maybe I'm just old school. And I'm going to sell the 233 strike call option. And then we're going to protect ourselves, and we're going to go down and buy the 236 strike call option. Very simple, very straightforward trade, trying to sell a little bit of volatility. If we go back and look at the chart, we're well above the 227 range, which was the most recent high before we kind of started tapering off in the small caps and in the IWM. So I'm paying attention to that range. So 233, we're selling this option contract, and this is going to be the official paper trade for today. And we're going to buy the 236 strike. We're getting this done. It's a 3-point wide trade, We're getting it done for a net credit of 42 cents to the account. Don't mind it. I would like it to be closer to 50 cents, but when I initially looked at it, the market has moved a little bit against this trade. 42 cents is not bad at all. And so our Our max risk is going to be the width of the spread, which is $3. And then you take the $3 minus the 42 cents, which if we do get the midpoint fill, there's never a guarantee that we're going to get a midpoint fill. We're going to have $2.58 of risk. Maximum we can make on the trade is 42 cents. If I'm doing this trade and I can ever close this, if I ever do a short spread for a minimal amount, and I think 50 cents is a minimal amount, somewhere in that range, we're looking at 43 here in this case. If I can close this for a dime or 15 cents, I'm always going to get out of the trade. And on the upside, I don't want to lose more than double what I put this trade in for. So if I'm doing it for 43 cents, some people will say I want to get out at 86 cents, right? So that's a double. So that means I could have made 43 cents. I'm going to get out at 86 cents. You have that means I would close that trade and lose the amount the maximum that I could have made. I prefer to actually let them ride a little bit more and give myself a decent opportunity, because you have a high probability of success on this trade. So in this instance, I'm going to let it run. And if it's trading for somewhere around 120, almost double what the net credit is that I brought in, then I would look to close it. And that's just the way that I like to trade my high probability trades. I'm still going to manage my profitability on IWM in general on the 40 cents. I'm still willing to close out that trade if I can get down to a nickel, a dime, maybe even 15 cents at some points, depending on where the market is at and what's going on. But on the upside, I give myself a little bit more room to run, knowing that more times than not on a trade like this, I'm going to be profitable because I'm doing a fairly high probability trade. All right. I don't see any questions or comments. And thank you for the question, Karen. I appreciate it. This is Brian Overby, the Options Guy on Options Guy TV. If you would like to learn more, please check me out inside the Tradier Hub. You can also stream this live on X and inside the Tradier YouTube channel. Thanks for stopping in. We'll see you this Friday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.